Hey guys, TommyBryson here, and welcome back to the channel. And in this video, I'm going to show you exactly over 20 companies to go ahead and invest money into. And this entire thing started out back when I was in college. When I was in college, I firstly realized that investing into the stock market was a real thing. I had no idea an average individual like me could put money into big, massive companies without being a billionaire or a millionaire. To me, that sounded crazy. So I had this goal to save up $10,000 to become an investor. And I did that. And that was awesome. And I did it on minimum wage. And to me, that was incredible. Obviously, you don't need that much money, but to me, that's how much money I wanted to have. But then I found myself with another problem. And the problem was that when I understood that the stock market is what a lot of companies basically are, I was like, yo, there are over 3,000 companies in here. How do I know exactly what companies to pick, which ones to ignore? And overall, the most important thing is obviously which ones are gonna make me the most money. Right? That's the obvious idea. So I didn't know how to do this. So I asked my professor this question. I told him, well, what do you think I should do? And at the time, again, I'm in college. The professor seems to be very smart. And he tells me, Tommy, just pick the companies that you know, you love, and you kind of understand and have been around for a very long time, and you're going to do great. And at the time, I became very nerdy about the stock market. So I was reading a lot of books about it, and everyone said, don't do that. You have to understand the companies, you have to analyze them, and you have to be a lot more like Warren Buffett and spend 8 hours a day studying financial statements. And I found that very, very boring, okay? But in this video, we are gonna try that out. We are gonna pick companies that we know, that we love, and we're gonna compare exactly how much money would I have made 10 years ago if I did that versus if I had just put that money, for example, in the S&P 500, which is basically the 500 largest companies in the entire stock market. And it's usually like an index that people basically use to track the performance. So if I did that, or if I just went crazy and said, well, I like this company and that company, I'm going to put my money in there. Let's see what actually happens. And I guarantee, guys, by the end of this video, your mind is going to be absolutely blown, like mine was. It's not like you're going to make, like, for example, 2 times more or 3 times more. You're going to make so much more money. And I'm not going to tell you which one, either like the good one or, oh my gosh, you're picking random companies. You'll see by the end of this video, okay? But overall, do me a favor and smash the like button. It helps out with the channel. And top of that, also, if you're new here, subscribe and welcome to the family and grab a carrot because this stuff is about to get very, very fancy, okay? But overall, the idea is simple. We're going to pick companies that we know, we love, we understand. So the best way to do this is I grabbed a little bag here and I went around my house, okay? And by the way, obviously, the first company is Walmart. I love Walmart. That's where I shop. I also love Costco. That's also where I shop. I also shop on Amazon. So right there we have 3 companies off the bat that I know, I love, and have been around for a very long time. But inside this bag, you have, for example, some Vaseline. You have, for example, some Sprite. You have some off. And for you, by the way, these are things that I use all the time, but for you, it might be different, right? You know, you have some Crest whitening strips because, you know, you got to keep the teeth super white, you know what I'm saying? And then you have, for example, a Sony controller. Like every single guy out there has one of these. And you have, for example, like, you know, Colgate, Sensodyne, and just a bunch of different items. So the idea is you go around the house and you kind of decide, what are the items that I use all the time? What am I using all the time? Where do I go to shop? Where do I go to eat? What are my favorite companies out there? And you become more analytical about them and you look them up. And by the way, you can't forget about Apple because Apple is everywhere. You can't forget about social media, Instagram, Facebook, and Facebook basically owns that, and WhatsApp. So you kind of start to create this entire list. And this is basically your list of companies that you're going to invest your money into. Now, I gotta be honest here. When I first started making this video, I was like, I'm gonna stick to 10. But then, as I looked around my house, I found over 20 companies that I basically like and I use and I love them and I understand them a little bit, okay? So overall, here's what I did. To invest my money, I use this platform. It's called M1 Finance. Yes, they have an app. Yes, the link is down below. And I also show you exactly what I invest my money into. So if you click that link, it shows you exactly what I put my money into. But I went over there, and for the first time ever, I created a portfolio around companies that I basically just like, I love, and I kind of understand, okay? And overall, here it is right here. The portfolio is literally named What I Like Portfolio. And I think I spelled something wrong. I don't know. But overall, I picked 22 companies overall. And here are the 22 companies. You have, for example, Google, Amazon, Apple, Costco, Facebook, Johnson & Johnson, JP Morgan, Microsoft. Yes, where you bank is important. What you wear is important. What you drive is important. I don't drive a Tesla, but I really like Tesla, and I find it pretty interesting, so I put it in there, and I love the company. I tried driving a Tesla, and it was amazing. Kind of weird at first, but amazing. Visa, Walmart, Cheesecake Factory, Chipotle. I love these restaurants. And now I don't live in the US anymore. I live in Puerto Rico, so we don't have Chipotle, but we do have Cheesecake Factory. But I do miss Chipotle so much. Coca-Cola, which by the way makes Sprite, and I love Sprite Zero, 0 calories, and it tastes amazing. Colgate, GSK, this company, if I'm not mistaken, makes Vaseline, so that's why it's in here. Intel, that's like technology stuff. PG, these people make literally everything, like everything. On top of that, Sony, Toyota, and UL. I forgot what this company makes, but it's somewhere written somewhere, so I'll tell you by the end of this video. But overall, these are the 22 companies that me, Tommy Bryson, personally loves and uses basically almost every single day. So now the idea is simple. I have 22 companies. What would have happened if I had grabbed my $10,000 and I would have invested that money into these companies? Well, first of all, I got to give you an answer to something else. And here's the first answer I got to give you, okay? Remember, I told you before that most people that invest into the stock market, they use the S&P 500, the 500 largest companies in the stock market, as a benchmark to show you the performance of your money or the overall stock market. So if I had put my money in the overall standard performance stuff, here's how much money I would have actually made. Overall, I would have turned $10,000 in 10 years into $35,883. If you ask me, that's actually not that bad at all. That's me basically making 3 times my money, 3x my money in 10 years. That's awesome. But what would have happened? And by the way, this is relatively basically very safe, very consistent, very passive. You put the money in there, you forget about it. But when you have, for example, individual companies, the problem is, hey, what if the companies that I basically love and I care about and I understand, what if they go bankrupt? I loved Blackbuster. I loved Radio Shack. I love Polaroid. It's still around. I don't remember if it's still around. But the point is, companies that you love, they can go out of business, okay? So that can possibly happen. And I forgot to include Netflix on my list because that's a company that I also use literally every single day, but I didn't put it on there. So put 23 companies, not 22 companies, okay? But again, what would have happened if I had grabbed the $10,000 and split it between 22 companies? Like overall, around 10 to 12 of those companies would have gotten 5% of the money, and then 4% would have gone to the other companies overall, okay? Now, I went ahead and used my mind to create an Excel sheet right here and show you all the facts. And again, you're gonna go crazy when you see how much money you can make by just basically picking the companies that you basically like and you basically love and understand in a way, okay? And don't worry, by the end of this video, I'll tell you exactly what I think of this overall strategy. But here are the results, okay? If I would have put money into Google, 5% into Google, as you can see, like these are the companies that get 5% right here. So about like 13 of them, well, 12 of them get 5%, and then 10 of them get 4% to add up to 100% overall. But here are the facts, okay? Google in 2012, 10 years ago, was worth $288. Today it goes for $2,226. Amazon was $195. Today is $2,173. Apple was $15. Today is $137, and so on and so on and so on. But my favorite here is Chipotle, obviously, because I love Chipotle. $354, and they're worth $1,274 per share right now. And here, this shows you exactly how many shares I could have bought at the time. And obviously, surprisingly, the company I could have bought the most shares in was actually Tesla. Because at the time, Tesla right here was only going for around $4.55 in 2012. So I could actually bought 109 shares. And by the way, there is one massive flaw with this information, and it's that basically every few years, companies, they have stock splits to basically lower the price so the average person can basically keep buying them, okay? So I'm not including the stock splits. That would have been way too much work, way too complicated. So I wanted to make it very, very simple here. So let's go back here. And by the way, if you want to, you can screenshot it so you can see all the information later on. But right here, you have the price. You have the percentage I put my money into here. So out of, for example, the $10,000, it got 5%. You have the amount of shares I bought, and you have the current price. Now, can you guess how much money I made overall? Well, I have it right here. Let me go ahead and unhide this. How do you unhide? I forgot. Yeah, here you go. Unhide. Here's the crazy thing. Out of 22 companies, I only lost money in one company. And in reality, that's not true because this company could have had a stock split, so it's not really fair. But I only lost $9. That's it. With a simple equation. And on Tesla, I literally turned such a crazy amount of money, okay? I literally turned, for example, $500. Is the 5% of 10,000 is 500 if I'm not mistaken, right? Just verify that real quick. Yeah, so it's $500. So I turned $500 into $77,961. With Google, I turned $500 into $3,300. Amazon, $5,000, $4,000. Look at this, guys, okay? $1,000. I mean, $1,500. I mean, the lowest amount of money that I basically made overall was $28 on the Cheesecake Factory. But again, if the company had a stock split, which basically means that they increased the amount of shares out there, but they give me more shares in return because they basically diluted the shares. So I would have had more shares to kind of like even things out. In reality, I probably made more money than this if they did have a stock split. But overall, can you guess how much money overall all of this adds up to? And don't forget, I only started out with $10,000, okay? Don't forget about that, okay? And remember, if I had put that same amount of money into the S&P 500, the standard, the boring stuff, it would have been $35,883, which, by the way, is still a good return. But over here, by just picking the companies that I know and I love and I kind of understand, I would have made a whopping $111,319.58. That's a lot of money, guys. That's an 898% return. That is incredible. That is Warren Buffett type returns, okay? That is crazy money just with a $10,000 investment. It's a lot. And just for fun here, if all I had was, for example, let's say not 10,000, but if all I had was, for example, $1,000 to invest, well, that still would have been $11,131, meaning you still would have made a crazy amount of money relative to the amount of money that you actually invested. But overall, by the way, I want to show you guys here, turns into $11,000 if you had gone ahead and invested $1,000 and not $10,000. Just so you guys know that I'm not making this stuff up, okay? Simple math, simple equation. But now I want to ask you guys a question. Well, answer the question that you guys are probably asking, okay? So Tommy, are you telling us that we should go ahead and put our money into companies that we basically love, understand, and have been around for a while and basically use every single day? The answer is the logic behind this is very simple. If you love a company, if you use the products every single time, then you're probably not the only one that uses those products. And other people basically love them. So the idea is, as time goes along, that company is going to continue to basically make more money, which in return will make you more money. It's kind of like odds, okay? The odds say that basically, if you like it, other people like it, and most likely it's going to make you money. That's the idea. But then the flaw is that a lot of companies that maybe you like well, they might not be around in 10 years from now, or 20 years from now, or 30 years from now. And like I mentioned before, I loved Radio Shack. Radio Shack is, can't break this carrot. My goodness, how you break this carrot? Radio Shack is no longer around, okay? It went bankrupt. That's my point, okay, guys? So it's kind of like saying, if you want to have some fun and you want to put money into companies you basically love, then it's not really such a bad plan, because it's just like really having fun. And if you're basically just gambling, picking random companies, might as well pick the ones that you basically like and enjoy and are going to be invested into, because when the stock market does go down, and that's one thing I didn't show you guys, but over 10 years, companies went like this, like this, like this, by this, but over the long term, they basically went up, okay? So if you like the company, if you enjoy the company, if you use the products, you're more likely to keep your money in there. But would I do this for a retirement plan? And by the way, I would like to go back and show you exactly what I actually invest my money into, and it's actually not that, okay, at all. So what I actually invest my money into is this, and right now the market is down. I'm down $20,000, but that's fine overall. It's gonna go back up. Everything's cool, okay? But overall, I have like $40,000 in extra cash flow, by the way. But that's awesome. But overall, the companies I put my money into are just basically 5 ETFs, and they are the boring things, okay? They are the VOOs, the Vanguard, S&P 500. It's also developed markets, basically boring stuff. That's what I put my real money into, okay? Now, why do I do this rather than just pick the companies that I basically like? Because what I'm thinking, guys, I'm thinking not just about like 5 or 10 years. I'm thinking about 30 years. I'm thinking about 40 years. I'm thinking about retirement. So you can tell me, I love Amazon, I love Google, I love Facebook, I love the Cheesecake Factory, but I honestly can't tell you if they're gonna be around when like 30 years from now. It's very hard to tell, because in business you have competition, you have bad management, you have times changing, like a lot of things can happen, and those companies basically go belly up. So if you're asking me, if you want to have some fun, I'm not against this plan. But if what you want to do is have, for example, just money that you have in there, you're going to earn money passively, it's more safe, and it's more standard, you don't have to take that much risk, the answer is I would still continue to do my index funds and my ETFs no matter what. And by the way, because I know some people kind of freak out here, I do want to show this, okay? Because people are going to say, Tommy, but you invested so much money and you're still losing money. No, overall, guys, I'm making money still. I'm still up $20,000. Although it shows like, oh, right now, relative to what I invested, I'm down $19,000. But in reality, what I actually bought it at, I'm still up $28,000 here. I'm still up $1,500 here. I'm just down on these, but in reality, it's just a part of the game. Markets go up, they also go down. When you invest this way, the only way I lose is basically if the entire economy flops. And at that point, individual companies probably won't matter that much. But the point is, individual companies are very hard to pinpoint, because the companies I loved the most when I was 19 years old weren't these, for example. Honestly, I used to love GoPro, I loved Radio Shack, I love all these companies that in reality, GameStop, and those companies basically went bankrupt. So your taste changes and it evolves, and so do other people's. So you can't really know exactly what's going to happen. But before you leave this video, I do have one last example to give you of someone that did this plan and it actually worked out for him. So this guy right here, you guys probably don't know him, but his name is Ronald Reed, and he's known as the millionaire janitor, because when he passed away with over $8 million, and he had a stock portfolio. That money was then going ahead and basically donated, but overall, his stock picking strategy was very simple. He picked a few good companies that he basically believed in, that he liked, and he kind of understood, and he kept putting more and more money into it over a long period of time. And then in the end, he had amassed a fortune, a lot of money. So it's not to say that it doesn't work per se, but it is to say that we don't really know exactly, well, what companies out of the 30 or 40 or 50 that Ronald Reed basically picked, which ones went belly up. So my advice is, if you want to do this, use a company like M1 Finance. The link is down below. And that way, whenever you invest $100 or $10,000, it automatically divides the money evenly, so that way everything's taken care of and you don't have to worry that much. But again, I will keep it on with the ETFs and the long-term stuff. But once I hit the goal that I actually want to hit, I wouldn't mind like having this little side portfolio and sending over like $100 a week or a month and just seeing that money build up just for fun. Just for fun. Okay. Hey guys, so black shirt, different day. I'm back. I could not sleep last night after making this video, not because I could have made so much more money, but because there's something very obvious here that I did not mention. And the obvious thing is basically called the 80-20 rule. So it basically means that 20% of the investments I selected were going to give me around 80% of all of the returns. And I don't know why I did not point this out, but I wanted to point it out to be transparent here at the end of this video. And that's why I could not sleep. If I don't get everything out and I feel like I left something out that's going to help you guys, then I can't sleep whatsoever. So here I am, back again, back against the wall. Let's get to the video, okay, guys? But overall, as you guys can see right here, the 80% rule basically says, right, that, you know, 20% of the investments are going to give you like 80% of all the returns. And 20% of 22 investments is around like 4.5 or so. So I went ahead and got like 6. And the major 6 companies here were Google, Amazon, Apple, Microsoft, Tesla, and Visa. And obviously, this is obviously not that accurate because, again, these companies went through multiple different splits. So it's actually would have made me even more money. But overall, if you see here, Tesla literally made $77,000. So that's an anomaly. That's a very lucky hit, okay? That's the equivalent of me picking a company and all of a sudden it made me a super amount of money. It's rare. It just happened to be Tesla. Now, who's to say that I'll pick another 22 companies or 30 companies I love, and then in 10 years from now, it's going to be another Tesla? The odds are not in my favor, okay? Honestly, like, it's very slim. And as you guys should notice here, I turned $10,000 into $35,000 in the S&P 500, which, by the way, is great. I basically made 3.5 times my money, which is awesome. But if I go ahead and I remove Tesla, right? So if I didn't get lucky with Tesla here, boom, you take that off. Well, how much money would I have made? Well, it's only $33,000. So if I take away those 6 main companies, I would have only really had a $13,000 return, which basically doesn't really equate to that much relative to what I would have made here. So overall, my conclusion is, okay, when you do select these companies that you basically like and you love and you care about, well, you might select a few winners and a few of them might be extraordinary, but some of them might just be very average with average return, like the other basically, what's 4 minus 22, like the other 18 to 17 to 16 other companies that I also love, but didn't really return such crazy return over 10 years. So that's my point here. I just managed to get Tesla. And by the way, the real official return after stock splits would have been roughly way over, like at least over 150,000, nearly 200,000, even probably more because of all of those stock splits. So overall, it's not a bad strategy, but I had to mention that because the 80-20 rule is very real. So if I did do this, I would do it after I was done with all my investing, create this portfolio, send some money over there, but understand that the law of 80-20 is very real, and also understand that in the next 10, 20, 30, 40 years, or 50 years, well, we might not have these companies around. So I would have some rules in place to say, well, once this company hits, for example, X amount or a crazy amount, I'm going to go ahead and shift over to another investment or so on. But then you get into a lot of speculation because you really don't know exactly how to value a company. But that's it. That's what I felt guilty about. That's what I wanted to tell you. And that's why I came back here and mention it on a different day. And I could not sleep last night. There you go. But guys, thanks for watching. I hope this video actually helped you. I hope you had as much fun as I did. And I can't believe I couldn't really crack a carrot. To me, that's pretty crazy, okay? But I'll see you guys next time. Like this video, subscribe to the channel, hit the bell so you get notified, comment down below any questions. On top of that, up here is another video. Here's my face. Click it and subscribe. And thanks for watching. Long-term team out. Follow me on Instagram at TommyBryson. And remember, carrots, they're good. They're strong and sturdy. Invest in carrots. What am I saying?